Yeah. Oh, hey everybody. Welcome, welcome, welcome. Today is Wednesday and I am down back live on the floor. Thank goodness it has been a while. Can everybody hear and see me okay? May even bring in a special guest over here. You guys that know Oliver Rennick from Schwab Network, he's no longer there, but he's down on the floor. You may come over with me. All right, Justin, thank you, thank you, thank you. David, all right, everybody. Um, I got to be honest with you. I've been talking. And smashed. Thank you. Got to be honest with you guys. I've been talking since last week that this week would probably be pretty slow because of the holiday and everything. And even though we have jobs number tomorrow morning, there is there's some business. There's some business. Volume is not as thin as I thought it might be. Um, it is. I was down here earlier this morning. I had a couple interviews, and it was really loud. It was really loud. Now, we're seeing the markets. They're on their high of the day right now. I'm looking up here. S&Ps are up 18. VIX is pretty much unchanged, sitting right 16 in change. Hey, Steve. And it's a pretty full crowd here. I don't know if you guys can see, but for a holiday week, it's a pretty full crowd down here. So let's hop into what we started yesterday. Okay, so we're going to continue our implied vol discussion, and must have been an interesting one. At least, hey Marty, a little bit, because I actually received a bunch of emails yesterday trying to or asking questions about extrinsic value and how does extrinsic value measure up with delta of an option, which we'll talk about. But I had a few people that actually copy and pasted and sent me this screenshot here to kind of explain what this is all about. Let me get my drawing pen here. I always forget to do that when I'm on the floor here. Hang on. Epic pen. Where are you? There you are. Okay. So right in here, everybody. Okay. Right in here. If you look at that and say, okay, that's the at the money, and this is measuring the amount of extrinsic value up here. What this tells you is basically a 50 delta option at the money, that's going to have the most extrinsic value to it. And the further deeper in the money you go, and we kind of touched on this yesterday, the less extrinsic value, and the further deeper out of the money you go, the less extrinsic value. So what do you notice here, right? If this is your 50 delta option, right in the middle here, and as you go further and further and further and further in the money, you get towards 100 delta. And if you get further and further and further out of the money, you get towards 0 delta. Okay. That represents very, very small amount of extrinsic value. Okay. Now, the Greeks are all intertwined, and I don't want to get off on a tangent with some of the other Greeks, but what you will also notice as the amount of extrinsic value, okay, decreases, 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 the same thing happens to Vega, okay, which we know Vega is directly correlated, directly tied to implied volatility, right? It's the um, measurement of how much an option changes as implied volatility changes. So a change in volatility is not really going to affect the outer edges here. Okay, it will a little bit, but a change in volatility will affect the at the monies. And you'll see that shortly here when we go to my screen. You're going to see that Vega is highest for at the money options. So Vega's highest, extrinsic value is highest. Okay. Oh, David, good. I'm glad that worked out. Excellent. Excellent. So when we're talking about extrinsic value and comparing, at the money, in the money, out of the money, we're always referencing within the same expiration. Further you go out in expiration, the more extrinsic value there's going to be, obviously. Okay, that's your time decay. Okay, so what are some ways we could take advantage of volatility, either when vol is really expensive or vol is really cheap? Okay. We always talk about when vol is really cheap, what do we want to do? We want to buy premium. We want to buy time, right? Because when vol is really cheap, that extrinsic value is cheap. So we're basically able to buy time on sale. Okay. So if we're in a situation where volatility is really, really low, okay, and you look at your charts and you say, I don't really know if this is bullish or bearish, but man, I'm going to play for a move in either direction. Okay. That's when a strangle can be a really, really good position if you are looking for a move and when vol is really cheap. And it's a good position for a couple of reasons. A, it gives you that exposure to both sides, upside, downside. But also, if you're buying volatility at a level that is really, really down low, okay, you can also make money as volatility increases. Okay. Now, if you buy a strangle, sure, you're going to have time premium. You're going to have theta on both sides of the equation because you're long a call and long a put. But that theta will be minimized, it'll be reduced when volatility is cheap because there will be less extrinsic value. Does that make sense? Okay. So again, when you really break things down and you think about it, all the Greeks are intertwined. They really are. Okay. Now, you can certainly buy a strangle or a straddle when volatility is more expensive. Okay. And when volatility is more expensive, it typically means that the market is pricing in a bigger move. And you can certainly buy ahead of that. But just remember, because volatility, implied volatility is mean reverting, okay, that vol is going to come down, especially if it's ahead of an earnings situation or some other event. As soon as that event is over, that vol is coming down. Okay. And like this says here, I'm looking, wow, lot of old time faces on the floor here. This is great. Like I put in here, okay, if you're looking at buying in anticipation of a big move when vol is already really, really expensive, you always have to measure where is that implied volatility. And that's why often we will put on a position when volatility is high, okay, like in anticipation of earnings or something, we will put on the strangle swap position, meaning that we're selling a really, really, really expensive strangle with the implied volatility that would be impacted most by the earnings, and then buying one that is also expensive. But when you compare the two together, and we normalize the implied vol because we know that both are going to get hammered. So basically, it's an arbitrage of buying a strangle out a week, 2 weeks, whatever it might be, selling the real close dated one against it to collect a bunch of premium. Okay, that would be about the only time that we would be buying expensive premium is if Ollie, want it. Special, I told you guys, special guest. Hang on. Hang on. You guys all know who this guy is, right?
What up? What up? We got
Yes.
What are we trading today?
What are we trading? We're closing out a lot of positions today ahead of the long weekend. We had some nice longs on, especially in
Yesterday was kind of
some of the
interesting.
miners, Mara, CLSK. Yesterday was very interesting.
Yeah. I was
Very.
recording something in the back of the Uber, which is kind of what I've been doing.
Oh,
Am I getting picked up
people
on the
like.
mic? You hear me good?
Can you guys hear Oliver here? Yeah.
Okay.
Okay. Good.
And so I was doing a little recording in the back of the Uber, which is what I've been enjoying lately.
Yeah.
Talk about the market, and of course, almost like I would say like 2 out of 3 times, the Uber driver's like, "Hey, you in the market? I'm trading. What do you trade?"
Oh,
So
that
yesterday she
that's when
asked me,
it's maybe a top, but
she goes, "Well, what should I be buying right now?" And I said, "You know what? Probably the short answer is like everything that just dropped today for an intraday
yeah,
trade,
for
for a
sure.
1 day trade." But I was looking today and it didn't seem. I mean, some of the stuff bounced back, but not like super hard.
SE didn't, crowd and snow, not so much, but
Master bounced back a little bit.
yeah,
MicroStrategy bounced back a little bit.
MicroStrategy did, yeah.
Uh,
Yeah, it's because Bitcoin's up, what, 4 grand today or something.
yeah, so that kind of repaired itself,
Yep.
but I'm watching that very closely. But overall, I was thinking of how to describe the market this year, and I've been thinking about this concept of um, the everyday trade or like the real life trade. Spotify,
Yeah.
which is one that is one of those products that I use all the time. The other one is obviously Hood has been like the stock of the year,
Crazy.
the
Crazy.
story of do it yourself,
We
basically.
we actually got into Bull
Like the same idea.
yesterday.
Okay.
It's kind of on the heels of Hood. The stock's up nice. Stock's up like almost 10%.
Yeah, that's been incredible. The other one I was thinking is Roblox.
Yeah.
The things and the services and the programs that you interact with. A lot of that has been the story of this year. Because the thing about Mags has been flat, basically.
Right.
Um,
Right. With the exception of Meta, really, or.
Meta, but Apple has been dragging on.
Mhm.
And I think why is because what's their real life product right now? They have to use their AI is
Yeah.
not on par with what it probably should be.
You
I know.
guys all have to listen to him, guys. And when we get a regular podcast or he gets his thing going here,
Yeah,
guys,
we're the
we'll
it's hard
yeah,
not to be down at the CBOE.
right,
So
right.
you got the allies, you got the friends.
Oh, I miss him on Schwab. There we
Rocket
go.
on chainsaw. That actually describes my skiing technique.
If you would see this guy on the slopes, yes, it does.
Learn from the best.
All right.
All right.
Thank you.
Appreciate you.
We'll talk.
See you soon.
Feel
Keep
better.
going. All right.
Yeah.
Thank you. You likewise.
Thanks. All right. Awesome, guys. Love having the rock star pop in here. Hopefully you were able to listen to him, and yeah, when he gets his thing going, and we'll be doing a lot of stuff with him. He's a great mind. He's someone you definitely want to listen to. Okay, back to here. So my go-to, someone in the room, who was it this morning? I forget. Someone in the room, if you're here, let me know. Asked me this morning, what's your favorite go-to strategy? My go-to, if the option gods came down and forced me into a corner and said, Scott, you can only trade one strategy, what would it be? It would be a time spread. A time spread is a diagonal or a calendar. Okay. And the excuse me. The reason being is because it is a great way to arbitrage volatility. It's a great way to, when vol is depressed, to buy time cheaply and sell something against what you're buying. Okay? So diagonal spreads, calendar spreads are phenomenal when vol is cheap. We also do trade them around earnings, but really when vol is cheap. The difference between the two, and most of you probably know this, the concept is the same, where we're buying time, sell something that expires sooner, buy something down the road. The difference is in a calendar, the strikes are exactly the same. So whether you're selling an option next week and buying one 2 weeks, 8 weeks, 6 months down the road, you're looking at the same strike, kind of like what we have in Nike right now. Nike, we had a calendar put spread. Okay. Diagonals, same concept in terms of using different expirations, different times, but we use different strikes. Excuse me. So in a diagonal, you get more delta bias, you get more directional bias, kind of like the spread that we have on in bull right now. That's a diagonal. Okay, but again, conceptually, we're trying to accomplish the same thing by buying time cheaply, stock moving in the direction that you're looking at, just a diagonal because we're using different strikes gives you more delta and directional bias. Okay. I didn't change this. We're still going to use the same Thor vol today as we did yesterday. And when we get that up there, I'm going to bring up some charts here and we're going to go through how we can see the extrinsic value, how it changes from in the money, at the money, out of the money, and how the Vega does the same thing, how it all ties together. Boy, Thor's a good looking dog. Thank you, Eric. Okay. Oh, what did anybody happen to fill in bull at $1.50? It's making, it's grinding its way up towards there. Any fills? Yeah, he is regal, John. I agree with you. Bear, you did? Awesome. Awesome. So, and Richard, excellent. So this was, you missed Aladdin the entry or you missed the exit? Which one? Okay. Thank you, RDB. Awesome. Awesome. Okay. So this is a diagonal. Why is it a diagonal? Well, we've got two different expirations, but two different strikes. So a diagonal is a combo of a vertical and a calendar. Okay, let's look at actually, you know what? Gilbert, you're the last one that just put something in there. Give me a stock you want to look at. Any stock you want to look at, Gilbert. Because what I want to do is really just identify out for you how extrinsic value changes depending where that option is relative to where the stock price is. NVIDIA it is. Okay. I'm going to make this super, super large here. If I could take that 150 off the screen, I would, but I can't. Sorry. Oh, no, I'm just saying this dollar, the 150 that's on the screen, I can't remove that off right now. Well, I could if I did, hang on. I guess I could. Switch monitor. There we go. Okay. Beautiful. Dunzo. Okay. Should have been removed. No. Why didn't that remove? I don't know, guys. Anyway. Okay. Here's NVIDIA. NVIDIA is trading 157. Okay. So we're right here with NVIDIA. Okay. So let's look at this 157.5 call option. Okay. That expires in 2 days, actually tomorrow. Okay. Is there any intrinsic value? Is there any intrinsic value to that call option right now? There is some business down here, guys. Okay, excellent. David, Gilbert, Gus. Right. It's out of the money. So there's no intrinsic value. So whatever it is trading, and it happens to be what, $1.07, $1.08 right now, that is all extrinsic value. That's premium. If you go further away, okay, so On the call side, if we go to lower strikes, let's just go to the 130. Okay. The 130 call is trading basically a penny or two over what's called parity. Okay, so with the stock trading 157.23 or 24, that call is trading, 27.25, 27.30. So there's minimal, couple pennies, maybe a nickel of extrinsic value. And then the same thing, if we go way out of the money on the upside, okay, you can see that there is very little extrinsic value. So the most premium is at the money. Now, let's see how that coincides with, and I'm going to get us, whoops. Let's move up a couple weeks here. Okay. This is just going out a couple weeks here. Let's do the same thing. Let's measure right at the money, 157.5. Now, boy, just going out a couple weeks, there's a ton of premium there, right? There's no intrinsic value. So there's almost, was it $4.30 or so of pure premium, pure extrinsic value. If we go way down in the money here, okay, how much? Let's see, this is 2280 with the stock trading 157.20. Okay, how much extrinsic value is there, guys? The 135 call trading 2280 with the stock 157.20. How much extrinsic value is there? I know I scribbled on the screen, but that's okay. Excellent, Thomas. Yes, spot on. Steve, perfect. 60 cents. Does everybody understand why it's 60 cents? But even if it was 45 or 70 cents, still you can see that the further and further and further you go away from the strike, away from at the money, the less extrinsic value there is. So perfect, 60 cents. And if we look, way out of the money on the upside, let's go to, let's say, the 175, there's only 30 cents. Okay, so at the money, highest extrinsic value, which also correlates to this column here, Vega. Remember, Vega is the measurement that tells us how much the value of an option changes as implied volatility changes 1 point. Just like Delta tells us how much the value of an option changes when the stock moves $1. So what you will see at the money has the highest Vega risk. Okay, meaning when implied volatility changes, the at the money options are going to be impacted the most. So you can see in NVIDIA here, the at the money is going out 2 weeks. The Vega is about 13. That means for every 1 percentage point that implied volatility changes, the value of that option is going to change about 13 cents. If we were to go again right back down all the way to in the money there, that Vega risk becomes nominal, 3 cents. And if we were to go all the way out of the money, same thing. Same thing. So you see how those two correlate? The extrinsic value is directly related to Vega, and it's directly related to timing, which is also theta. Does everybody see that? Excellent. Excellent. Okay, now where did my presentation go? I'm all flummoxed down here. I guess that's a word. Hang on. All right, here we go. Okay. So, any questions, guys, before we get back to Thor as we put up final call of the day here for VOL? And as a reminder, there will be no market minds tomorrow because the markets close at noon Central. And there will be no market minds on Friday because hopefully we'll all be out celebrating July 4th with the markets closed. So, does anybody have any question about implied volatility? Why is it is so incredibly important? Its correlation with other Greeks, its correlation to extrinsic value. I still can't believe how active it is on the floor right now. All right, now I'm going to assume that we are all good then. Nobody has any questions here. And we're going to get to the wheel here in just a moment or so because it is closed now. I love the hubbub going on here, guys. This is awesome. This is awesome. All right, so let me get the wheel. There we go. Oh yeah, love to see pretty full wheel, guys. All right, yesterday's winner was I can't even Vincent. Yes, Vincent was yesterday's winner. Vincent, if you are on here, which I don't think you are. Nope. Perfect. All right. Let's give it a whirl here, folks. Let's give it a whirl. Kevin's ready to go. Here we go. Steve Mailman, Stephen Frystack, Thomas Swift. Who is it? Here. Stephen F. Are you here? Let's go. Get that hand up. Let us know you're here, Stephen, so we don't have to spin again. Beautiful. Hey, hey. You know who was famous for hey, hey? Jack Brickhouse. Iconic Cubs announcer, Hall of Famer. Nicely done. Nicely done. Nicely done. All right, Stephen, as you know, we'll post it up here. Shoot me. There it is right there. Shoot me an email at prosperswag@prospertrading.com. Let me know your size. Let me know your mailing address. Happy to get you out some swag. We do need a Prosper cowbell. Yes, we do. We absolutely need that. Haven't put that into production yet. All right, everyone. Thank you. Thank you. Thank you. Again, reminder, no market minds tomorrow or Friday. We will be back on Monday. All right. Yeah. Nice to see Oliver. He's sitting over here right now because let me see if I can turn the camera. Ollie, where are you? No. Why can't I get Oliver? Oh, he's there. It's just you can't see him behind. There he is. There he is. Yeah, he's looking at filming some stuff here. So anyway, here's the floor, guys, for those who haven't joined us before when I've been live on the floor. Yes, the background is real today. It is absolutely real. There is live trade here going on. This is the only place in the world that you are going to see that live trade going on. So, all right, everybody, we would love you to do the fly-in he left Schwab about a month ago to pursue some things on his own, and he's a really smart cookie. He will be whatever he winds up doing, he will be successful. Gene, thank you. Thank you. All right, everybody. Have a great rest of the day. I'm going to head back upstairs to the office. Thank you, Stephen. There's some trade going on. We'll get after it. And we will see everybody on Monday. Take care. Be safe, everyone.